With earnings seasons behind us, investors are putting more emphasis on the economy. And when those economic numbers don't match expectations, what happens to equity prices? Paul Hickey is the co-founder and managing partner at Bespoke Investment Group. Paul, good to have you with us. Thank you very much. It seems as though, as I said, you take a look at the chart, but in the short term, it seems as though the market just seems to climb a wall of worry. Yeah,
I mean, the last few days, it's been a little bit, back and forth. But, yeah, there's so much fear that we've come too far too fast. But, everything we look at historically tells us that going forward, it's hard to believe it, that the market has continued higher. When we look back at other 50% rallies in the Dow over a 8-month period, the 5 other times that's happened, the market's been higher 6 months later by an average of 12% every time.
So don't sell the rally short necessarily. I don't mean that literally, but I mean that it might still just continue.
Yeah, we've said this a couple months ago. This is the most disrespected bull market, of my lifetime easily.
What about volume concerns? Because we were talking about those last time as well.
Well, volume has been light, but volume's been light on up days and down days. But what we did is we looked at when we had the market hit new highs earlier in the week, new closing high. We looked at the days where the volume on up days and the days on the volume on down days, and so we just netted it. So on a down day we subtracted the volume from a total, and on the up days we added the volume to the total, and the volume, net volume is at its highest point of the bull market. So, it hasn't been strong, but it hasn't been strong on down days really or up days.
So kind of canceling each other out.
Yeah, I think so. And we've lost so much. A lot of firms were wiped out a year ago. So you're dealing with less players as well, and that's going to have an impact on volume.
On the number of players means less people playing in actual trading.
Right.
Well, let's talk about one theme in the market. It has to do with companies that generate a majority or a great deal of their sales outside the United States to take advantage of the depressed value of the U.S. dollar.
Right.
Now, you've done a study, you've taken a look at all the companies in the S&P 500, and you've come up with an interesting list. Colgate-Palmolive, for example, 81% of their total revenues outside the United States.
Yeah, I mean, these consumers, a lot of the consumer staples companies, you don't realize it, but some of the bigger ones like Colgate-Palmolive, they generate most of their sales outside of the U.S. And while the weak dollar long-term is a negative, I think, for the American economy, in the shorter term, these companies are benefiting on the currency translation.
All right, so you got Colgate-Palmolive, 81%, 74% of Coca-Cola's revenues coming from outside the U.S.
Yeah, it's not an American company the way you think about it.
What about, there's another one, Waters. People may not be that familiar with the healthcare company, WAT. What are we talking about? 70% of the revenue.
Yeah, so I mean, there's a good percentage of companies in the S&P 500 that are more international companies than they are domestic companies.
All right. Now, you've also taken a look at perhaps some 3 potential winners. You're going to talk about Duoyuan Global Water. As you say, most people in the business, they just call it DGW. It's much easier. Also, 3M and MasterCard. What's the theme?
Right. Okay, there's 2 themes. First, it's the weak dollar.
Okay.
So these companies generate most of their revenues or do most of their business outside of the U.S. The second theme is we've just passed earnings season, so we want to look at companies that what we call them are earnings triple plays, and these are companies that beat their earnings forecasts, beat their revenue forecasts, and raised guidance. So all 3 of these companies, with the exception of MasterCard, which didn't provide guidance, but all 3 of these companies were so-called earnings triple plays. DGW is a recent IPO from the summer. And,
but the company's been profitable since '92.
It's been profitable since '92, but it's only been public since earlier this year. But the company, they are a Chinese company, and they specialize in selling supplies for water treatment. And so it's a play on not only China, which is the strongest economy in the world right now, but also on one of China's most pressing needs, which is clean water. So this company stands to benefit on, for both those aspects.
All right, moving from DGW, tell me about 3M. We're talking about a 3% yield, 60% of the revenues outside the U.S.?
It's a more international than domestic company, 3% yield. And, they're leveraged to the international markets and to the industrial sector. And as we saw this morning, the OECD, they doubled their growth forecast for next year. So if we start to see an economy a global economy that grows stronger than most people are expecting, 3M's a perfect candidate to win.
All right, and what about MasterCard? Because there's something to do with the legislation, right?
Right. MasterCard, there's been an overhang in the stock over that Washington was going to come in and say the fees that they're charging are too high. MasterCard, today the GAO said that they gave the indication in a report that they're not likely to impose any restrictions on fees. And so that's a big overhang for the stock. And again, it's over half the revenues outside of the U.S.
That's what helped move the stock very much. Thank you very much. Paul Hickey coming from Bespoke Investment Group. Appreciate your analysis.